Welcome back. You're still tuned into Buy Now, Sell Now right here on ET Now, and turning out to be another soft day for Indian equity markets after the union budget yesterday. Nifty is now down about 111 points as we speak, trading near that 24,700 mark. But yes, we have had a whole host of earnings over the last few days, and one such candidate is LIC Housing Finance. Remember that net interest income saw an uptick of nearly 3 to 5% both on a sequential and on a year-on-year basis, and net interest margins have seen an expansion. But to understand whether the trend is sustainable and what the outlook is going forward, we now have the Managing Director and CEO at LIC Housing Finance, Shri Tribhuvan Adhikari, now joining us. Mr. Adhikari, morning. Thank you so much for taking your time out and joining us here on ET Now. And first up, let's talk about your disbursements that have grown by about 4% sequentially in the third quarter, which is better than the second quarter but still modest as compared to industry average. How do you read the disbursement figure? And you also mentioned that third and fourth quarter are traditionally stronger for you as compared to the first half of the year. Can we see growth improving further in the fourth quarter? What's your outlook for the next few quarters?
The growth would be definitely improving in quarter four. The quarter three has been quite challenging for us, honestly speaking, with the lowering of interest rates by RBI right since Feb of 2025. There has been a lot of pressure on margins for the company. And as I said in the beginning of the year, this year, given a sort of push to the wall, I would prefer to protect margins. So this is precisely what we have done this quarter, right? Instead of going gung-ho on business, we have tried to protect our margins, and this is reflected in our NIMs, which has grown by 7 basis points from 2.62 to 2.69. But now I believe we are leveraged, we are competitive. Whatever reduction in the rates had to be done for new loans as well as existing loans has been done. I do not personally foresee any change in the repo rates in the Feb MPC. So I think all this is taken care of, and Q4 is going to be a quarter of performance. And we will definitely see a much improved performance in terms of disbursements and loan book growth as far as Q4 is concerned.
Sure. With the loan book growing just about 5% year on year, even after Q3, is the earlier 10% FY26 growth guidance still achievable, or a revision in guidance is there?
Quite difficult right now, honestly speaking. As I said, this entire quarter we had been trying to protect our margins, and also we were in a quandary as what to do with the existing borrowers. And we were witnessing a lot of pressure in our existing loans, which customers tended to move out to banks specifically because their rates are directly linked to the repo. So whenever there's a repo cut, they do not have a choice. The rate automatically gets revised. So this quarter, we witnessed a lot of outflow of loans from our books, almost to the tune of 4,000 crores. But towards the end of October, we have also taken a call and in not changing our repo rate or LHPLR, as we call it, but we have revised our rewriting rates. We are offering rewriting to the customers at reasonable rates of interest. So there has been, in the month of January, there has been a significant reduction in the flow out of the BT out from the books. So I expect that the book will show a better growth in Q4, up from 5% right now. Yes, I'm not very sure whether we reach a double-digit growth, but we will definitely try to come close as possible to the double-digit growth which we had guided in the beginning of the year.
Right. Mr. Adhikari, you had at the end of last quarter indicated that balance transfer pressure had normalized in the last quarter itself. In the third quarter, can you share what the balance transfer out run rate was and whether it is now back to historical levels or perhaps some more quarters to go for it to normalize?
Well, not exactly back to historical levels in quarter three. Quarter three, as I said, we did witness balance transfer out pressures. It was only in late October that we decided to reduce our rewriting rates, as I said, the rates at which we rewrite the loans and reset the loans for older customers. So the impact has been not much in quarter three, but quarter four in January, we have witnessed that we are back to our normal rewriting levels are about 1,000 crores a month, which is the normal BT out we have been experiencing all through. So I think the pressure of BT out is taken care of now, and in Q4 we will back to a normal. We'll be back to a normal levels of about 1,000 crores a month.
Let's talk about the NIMs. NIMs have recovered to 2.69% in Q3 due to lower cost of funds sustainable level. Or is there a scope to move closer to the upper end of your earlier 2.6 to 2.8 guidance?
Well, yes, we have been quite aggressive in negotiating the borrowing costs of our loans. This year, we have made a conscious shift. Till last year, the ratio of fixed rate borrowings to floating rate borrowings was almost 55 fixed and 45 floating. This year, we have been able to manage to bring it to 50-50. That means 50% of my borrowings, the entire borrowing book is fixed and 50% is floating. The intention is to increase the floating component of the borrowing book that we are doing through loans from banks linked to the repo rate, so that in future, if ever there is a rate, if there are further rate revisions, we immediately get the impact of the lowered rate cost of funds. The NIMs at 2.69, I believe, are very much sustainable. In fact, we would try to improve on them. Of course, the scope for much improvement does not appear to be there. But definitely the guidance which we had given in the beginning of the year, 2.6 to 2.8, that we will definitely maintain. And I believe this 2.69 is very much sustainable.
Right, so that's as far as cost of funds and its impact on net interest margins is concerned. But Mr. Adhikari, let's also talk about incremental borrowing costs, which is now below the average cost. How much more benefit should flow into margins over the next 2 quarters? And if at all there's another RBI rate cut, which is rather not expected in the meeting, but if at all that were to happen, how would that impact your business and net interest margins going forward?
Well, I think, as I said, NIMs at 2.69 at the end of Q3. Yeah. I think this is sustainable. Yes, we would be in this range, maybe 1 or 2 basis points higher, but it is not going to be drastic that we are not only going to jump up from 2.69 to 2.8. It will be in the range of 2.7, let us say. I would say, safely we will be in the range of 2.7 when we end the financial year. And as far as the RBI policy is concerned, 125 basis points cut from Feb of 2025, another MPC in the month of February coming up. Honestly, I do not, personal opinion, I do not foresee another rate cut in the February MPC. I think the RBI should hold the rates at where they are.
All right. Let's talk about ECL provision in Q3. These were elevated despite improving stress. Are we now at peak conservationism on ECL provisioning? And should we expect recoveries and lower credit costs to support earnings going forward?
Yes, I think the ECL provisioning is at its peak with a PCR of 54.50. I think we are well provisioned. There is no need to create any further provisions. And if you look at our overall provisioning for the quarter, it has the increase has not been much. But yes, because of certain stressed accounts where, as per our management overlay policy, we had to take additional management overlays, the provisioning has been slightly higher. But overall, the asset quality has been improving. The GNPA ratio is at 2.45, down by 6 basis points quarter on quarter. The net NPA is at 1.13, again down by 6 basis points. So as far as the asset quality is concerned, it is improving, and we are very optimistic it is going to improve further. As per provisioning requirements are concerned, I think we've hit the peak. I don't think in the future there are going to be any further increase in provisionings.
Okay, so the asset quality is improving and provisions have hit their peak. That's the word coming in. Mr. Adhikari, thank you so much for taking your time out and joining us here on ET Now and helping us understand what the outlook is for LIC Housing Finance going forward. But on that note, we need to slip into a very short break. More news and updates will continue on the other side. Don't go anywhere.